All right, welcome to Talking Investing. I'm Tom, and as always, this is not financial advice. Today, I want to talk about Jerome Powell and the Fed. Jerome Powell is sitting in front of Congress right now, and something he said earlier has caused the market to take a turn to the downside. So I want to go through what he's talking about. There does seem to be a shift in what he's saying, so I want to talk about the ramifications of that. We do have a Fed meeting in 2 weeks, so we're going to get a rate hike in 2 weeks from tomorrow. So I think it's crucial we go through what Jerome Powell said and how it's going to affect the market. If you're new to the channel or you have not yet subscribed, please remember to subscribe to the channel, smash the like button, and hit the notification bell to get notified whenever we put out a video. Also, anybody who's interested can support the channel by hitting the join button on the YouTube page. It's right next to the subscribe button. We have a significant catalog of members-only content built up, and we do a once-a-week members-only live stream, and we have a members-only Discord. So I appreciate everybody's support. Let's talk about what's going on with Jerome Powell. So if I'm at yahoofinance.com's homepage, you're going to see the top story here is Powell tells Congress rates will likely be higher than previously anticipated. I want to dig into what he said and what the effect of that is, because I really don't think that this headline actually captures what's going on here. Okay, in order to get the full understanding of what's going on here, I want to go back to something that Jerome Powell said on November 30th. Fed Chairman Jerome Powell signals slowdown in rate hikes, what the experts are saying. So forget the experts, I'm going to tell you exactly what Jerome Powell said. Okay, in a speech delivered at the Brookings Institute in Washington, D.C. on Wednesday, Jerome Powell acknowledged that the monetary policy affects the economy and inflation with uncertain lags. As such, the full effects of the Fed's rapid series of rate hikes have yet to be felt. So he goes on to say, thus, it makes sense to moderate the pace of our rate increases as we approach the levels of restraint that will be sufficient to bring inflation down, said Jerome Powell. The time for moderating the pace of rate increases may come as soon as the December meeting. So this is what he said on November 30th. So that was a big signal to the market. We had been having a series of 75 basis point rate hikes, I think 4 in a row up until Jerome Powell said this on November 30th. You're going to see in June, July, September, and November, the Federal Reserve raised rates 75 basis points. So on November 30th, he said it might be time to start slowing down. So in fact, of course, 2 weeks later, we see on December 14th, he did slow down. He went from 0.75 to 0.5, so 50 basis points. So fast forward a month and a half later to January 31st, and really this came out on February 1st. And now you're going to see a 25 basis point rate hike. So that is a further slowdown. So what Jerome Powell said on November 30th, basically he had been sticking to ever since then, and that's over a 3-month period of time. The Federal Reserve is getting awfully close to what, in my opinion, is the peak that they can raise rates. In my estimation, probably they can raise rates another 100 basis points in total at a maximum before they really start to do some harm to the economy in other ways. So there is a limit to what they can do. They have to be judicious with these rate hikes, and that is why I think they slowed down. They would rather continue to raise rates slower over a longer period of time than use all their rate hikes all at once and then run out of what is really their number one weapon to fight inflation. The market was expecting this 25 basis points. It had priced in maybe 2 more 25 basis point rate hikes, potentially 3 more, so that was the argument. I want to show you now what Jerome Powell said today. Okay, Powell tells Congress rates will likely be higher than previously anticipated. So this is a little bit of a reversal, but that is not the important sentence. Let me go down a little further. The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated, Powell told the Senate Banking Committee in prepared remarks. If the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. To me, that is the absolute key to what's going on in this sentence. Not so much that these rate hikes may go on longer than anticipated. He has been signaling that now for several months. What he did say crystal clear on November 30th of 2022 is they were going to slow down the pace and wait to see what the effects were. Well, January CPI data was a little bit disappointing. It was lower than December, but it missed expectations. So we have CPI coming out again next week. So that is going to be a critical thing because we have a Fed meeting 2 weeks from now where they will raise interest rates. The question is, are they going to raise them 0.25 or 25 basis points, or are they going to raise them 50 basis points? So the market had priced in quite strongly that we were going to get a 25 basis point rate hike. It's been shifting a little bit day by day over time, particularly as we saw CPI come in worse than expected in January. Now, if CPI comes in worse than expected again in February, or worse still, if CPI actually goes up in February versus January. I do think that would open the door potentially to a 50 basis point rate hike. I think they do not want to do that. I think they're going to do everything they can not to do a 50 basis point rate hike. But if we see inflation now moving in the wrong direction, they may be forced into a move they really, I believe, don't want to make. Okay, so this article ends by saying, echoing his hawkish speech from Jackson Hole back in August of 2022, Powell said, the historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. So he said that 7 or 8 months ago in August of 2022. He said that exact sentence every single Fed meeting since then. So he's made no bones about the fact that they are not looking to loosen up, and they're going to do this for as long as it takes. He's been very specific that the bigger problem by far would be to stop too soon and lose control of inflation. He would rather raise interest rates too much, because that's a fixable problem that they can immediately fix by lowering them, than not raise them enough and lose control of this inflation situation. So you can see right now there's about a 34% chance of a 25 basis point rate hike. What I want to show you is if you go down below, you're going to see 1 month ago today, that was at 90%. So the market was almost completely priced in that this was going to be a 25 basis point rate hike. That has shifted. That went from 90%. Last week, it was down to 76%. And now all of a sudden today, it's dropped several times already today. It's down to 33.9%. We'll see where it ends up. But you can see now the market is favoring a 50 basis point rate hike. So that is why basically, as this statement was released, the market went from green to red. So at this time in the day, we're in the middle of the trading day. The market is still red. However, it is off of its low. So we're going to see where this number goes the rest of the day. And then we're going to see where it goes over the next 2 weeks. Because again, I do think it's my opinion that if CPI comes in as expected, and I want to take a look at what that is. So this is the CPI data over the last year. You can see it peaked at 9.1 back in June of 2022. In December of 2022, it was 6.5. In January, which is the last numbers we got, we were expecting 6.2. That came in hot at 6.4, so that was worse than expected. However, it was still better than the 6.5 from the previous month, so it was still trending in the right direction. So what I'm saying is, right now, the Trading Economics forecast has this month coming in at 6.2%, so that would continue this trend downward. But even if it were to be 6.3%, that would still continue this 7-month trend we have of inflation moving down in the right direction. Now, it may not be going as fast as we want, but at least it's moving down. So I do believe if this is 6.3 or lower, I think we get a 25 basis point rate hike. If this is 6.4, I think we still probably, I think the Fed's going to want to try to keep that at 25. But if this spirals and this starts to go back up, even if it's just a 6.5, that is going to be a trend in the wrong direction. That is going to disturb markets, and I think the Fed may feel forced to take some extra measures and do a 50 basis point rate hike, which again is not ideal for them. I think a series of 25% basis point hikes, probably at least 3 of them, is what they're looking to do. So I think they're going to try to stick to that if they possibly can, which means in 2 weeks and 1 day from now, they would like to do 25 basis points. And again, the key sentence is, if the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. One of the biggest weapons the Fed has is to remain consistent and stick to very strong talking points. So I am not surprised that he said this. I think he needed to say this, but I do still think we're up in the air as to whether it's going to be 25 basis points or 50 basis points. But with him saying this, the market did have an immediate reaction. This is a chart the FOMC put out in December, and this is where all the Fed members thought rate hikes would be in the years 22, 2023, 2024, 2025. So this period right here is the year 2023. So you're going to see there was some consensus around what would now be 2 more rate hikes. This was the biggest consensus. However, there were plenty of members of the Federal Reserve that did think we were going to need 3 more rate hikes. There were even a few that thought we would need 4 more from here. So we're not outside of what they reported basically last December. It's just people were starting to count on this lower number being the top. And it looks like right now we're probably going to end up going a little bit higher than that. That's why the market took a turn for the downside. I do think the market could even catch up by the end of the day and go green by the end of today. We'll see how the market is reacting. It's a crash in the market today. It was just a little pullback, so I'm encouraged. So again, to sum up, 2 things we're looking for is CPI CPI data next week and the Fed rate hike in 2 weeks from now. That, I think, will drive the short-term action in the stock market over the next 3, 4, 5 weeks. If you made it this far, remember to subscribe to the channel, and you can also support the channel by hitting the join button. Thanks so much for watching, and we will see you in the next video.